It's coming up now.
Yeah.
I can see the cover slide of your presentation now, Steve.
Terrific, Mark. Thanks. We just get all that technology. There we go. All good. Okay.
Yeah, perfect.
Thanks, Mark, and thanks again for hosting us, mate. It's I think it's possibly a third or fourth presentation through Copy Microcaps, and yeah, really appreciate the opportunity to talk to investors and potential investors. So we might get cracking through our presentation. Firstly, just I guess under this assumption there'll be some people on the call today that potentially don't know much about the business. So just to give some of the snapshot of the high level stats around the market size of Acrow, etc. So you can see the share price of Acrow has done pretty well compared to the small odds over our life as a public company. Although I will point out today that the business is still trading at not much more than 5.5 times earnings at the moment, despite what you'll see is an incredibly good year last year and also forward forecast. So I continually get told that we're good value, but I'll leave that for others to judge. Revenue heading towards 170 million, up from 80 million when we listed. This business, as an Acrow name, has been around since 1950, but the business in its current structure really has only been in place for about 9 years. Out of Boral into private equity, I came in about 9.5 years ago as CEO, and took it into a public company land in April 2018. We operate in every state in Australia, and we have 10 depots, 280 people working for us, and 1,300 odd customers. We are basically a formwork and industrial scaffolding business, and we do small scaffolding in some commercial work as well, but primarily focused on civil infrastructure market and the industrial markets. We provide engineered formwork sales and hire solutions. So formwork basically is the equipment that sits under the pouring of wet concrete while the concrete cures. And you'll see, I mean, that sounds quite simple, and it's everything from sort of a slab in a car park to some of the most high level important infrastructure projects in the country, which we've now got a major foothold on basically every one of those major projects. We also provide specialist screen systems, which you'll see some photos later on, I think, in the presentation of that basically that's on a high-rise commercial or residential development. Instead of scaffolding as an edge protection, it's a screen system, which is again more engineered and a better solution. We hire and sell and also provide labour into the industrial sector, primarily in major organisations that are doing shutdowns. For example, right at the moment, we're working on the Visy pulp and paper mill at Tumut. We're providing all the access equipment and labour for moving that access equipment around to enable their current shutdown that goes for about 8 weeks. And we dry hire scaffold into the commercial sector. Mentioned that we have 10 locations across Australia, so we're in every capital city plus Launceston. We also have two depots in Sydney. We've got 3 in southeast Queensland, 1 in Victoria, 1 in South Australia, 1 in Western Australia, then 1 in Hobart, 1 in Launceston. We've really developed a very strong reputation for ourselves now as the leading provider of this formwork equipment into the civil infrastructure market. We're looking to, that's sort of come out of a very strong Queensland base for us. We're looking to grow that further in New South Wales and Victoria, and there's some really good success in that area for us. And we're looking to aggressively grow our national industrial services footprint, which at the moment is based in New South Wales and Queensland, and looking to develop that in South Australia and Western Australia, where the markets are very, we're probably the largest markets in the country. In terms of the Acrow sort of way and the competitive advantage, one of the main things that we've done over the last 4 years has basically become an engineering company. So that's the way I describe us. If somebody asks what we do today, we are primarily an engineering company for providing solutions for temporary works. We believe we've got the best engineering group in our industry by some distance now, which we've developed over the last 4 to 5 years. So the quality of our people is excellent. We've become, I think, very strong sort of employer of choice in this area. And then we've definitely got the best mix of product range and geographic footprint of anybody in our markets. So there's certainly companies in certain markets that will be bigger than us. For example, we're not the biggest provider of formwork hire and sale equipment in New South Wales at the moment. We're growing that market share quite considerably, but we're certainly by far the biggest in Queensland, more than 60% market share. We're probably the biggest down in Victoria, heading that way in Western Australia. And that comes off the sort of, I guess, the balance between our ability to move gear around the country as different markets are in different situations, and just the range of products that we have compared to our competition. As I mentioned, I classify now as very clearly as an engineering company. Between 2018, when we listed, to 2022, we've gone from about 43% of our revenue coming out of what we would classify as engineered systems, which is our formwork and industrial business, to 84%. So we've pivoted the business from being primarily a commercial scaffold business now to, you see, in 22, only 16% of the revenue of the business came out of commercial scaffold. Doubled the number of engineers in the business, 15 to 32. That number actually is now 35 as we go into the new financial year, and we've got a couple of new things that we're doing. And in this space we operate in, where it's an engineered solutions business, price doesn't really become the factor here. It's around providing solutions that will save time on projects due to the quality of the equipment, the backup service our engineering people will provide, safety of the equipment, and I think, focusing in the areas that we do, we're heavily exposed to government-funded civil projects. There is extremely strong civil construction tailwind still for at least the next decade, despite what you may sometimes read in the media. I know what's going on the ground, and I've got some slides to show a bit later on about what I really know is going on the ground. And the sort of the nature of the market at the moment is that projects are being delayed in conclusion, and they're certainly taking longer and costing more. That's not bad news for us. As a hirer of equipment, we start hiring the day a project, gear leaves our yard. We stop hiring when it comes back into the yard. So if there's project delays due to labour, not a problem for us. We don't supply any labour at all in the civil infrastructure space. As I said, pricing is a secondary focus compared to quality, and certainly there's in an area, I think it's well known again, construction can be an area of some concern around bad debt opportunity or bad debt risk and quality of debtors. We've got very small exposure to the commercial area, where there's more risk in that area compared to our civil infrastructure and industrial space. So 22, that seems like a long time ago now. We're only 3 months into 23. Was an absolute watershed year for the business. Record financial results. It was all based off organic growth. We've still got a record pipeline of work in front of us at the moment. The growth was across basically all states and markets, and we go into 23 in pretty rude health. Just want to show a picture of what's happened to the business over the 4 years since we listed. So we listed in April 2018. So you can see over the 4 years, our revenue's gone from 65 million in the first year as a public company to 148. That number will be 170-ish this financial year. So 23% average growth per year in revenue over the 4 years. EBITDA has gone from 13 to 36. We're forecasting at the moment that to be 44, although that's moving on a fairly rapid pace. So, we will probably be putting out additional guidance probably around the time of our AGM in November. So we're 29% up at the moment every year in average EBITDA growth. EPS 57%, so 1.2 cents a share to 7.2. That's now heading into the high 8s and potentially even early 9s in terms of our earnings per share. And as I mentioned earlier, our sales contribution is from engineered services has gone from 50% to 88%. And really importantly, in a business that's growing its revenue as quickly as we are, we're not doing it to the detriment of margin. So margin in 18 it was 20, it was 24.5 in 22. Year to date in 23, it's 29. So we're tracking very well in that direction in terms of our maintaining and improving our margins. The actual results for last year, up 40% in revenue, up 49% in EBITDA. Statutory NPAT tripled. So we've been saying for some time to our shareholders that we were going to be getting scale in terms of NPAT and EPS. We've done a couple of acquisitions 3 and 4 years ago, so it just took a while for I guess our results from terms of depreciation and interest costs off the back of those acquisitions to catch up from an NPAT perspective. And you can see our statutory NPAT went from, tripled in last year. Our underlying NPAT doubled. Our EPS nearly doubled. We declared a 1.5 cent per share final dividend, which made 2.7 cents for the year, which is the biggest dividend we've paid. And again, importantly, in a business that's investing a lot in capital and growth, the return on equity had a significant increase between 21 and 22, and that continues again into 23. Last year, some of the key achievements. First one there is, we've got a mix between our industrial services business, where it's a lot of repetitive work and longer term contracts. And then we've got our formwork business, where you do go package to package and contract to contract. And it's really important that you continue to win packages as they become available on the major works. Last year, we secured 50.4 million of new higher revenue contracts, which is the higher revenue really is the profit engine of the business, up 28% year on year. For the first 2 months of this year, in the months of July and August, we're actually up 97% on the same period last year in terms of winning new work. Now, this is probably, well, I know it is. It's a 6-month odd lead indicator, which that gives me the confidence to be able to put out forecasts already, put out guidance forecasts sort of 2 months into the new financial year. I'm not sure many companies are doing that, but we can, because how well we can see the line of sight that we see on our future revenues for at least 6 months off the back of the higher contracts that we secure. The growth all came organically, as I mentioned. Industrial services, we put a lot of effort into growing that business outside of its traditional Queensland base. The revenue in that business doubled last year. The sales contribution went up by 50%. Had a great year in Queensland, which is our key market. They're up 50% in revenue in formwork. We had really good growth in what we call our smaller states. So WA, SA and Tas are smaller states for us compared to New South Wales, Victoria and Queensland. But they all had tremendous years last year that, again, that's continuing into next year. And in a year where, no doubt companies were challenged by supply chain logistics issues, we took some really significant steps that I'll just talk about, one in particular in the second, around timber and ply that we sell into the formwork market. Good results in safety, although zero is your target, so we've still got some work to do to get zero. But we had 4 lost time injuries last year. Clearly, our target is 0. Here's the civil infrastructure spend chart. I don't believe it. I say this on a regular basis. This is a public document, but the peaks in 23 and 24 won't be there. It'll be longer and flatter due to the availability of labour primarily, and that's fine by us. I expect, that's why I'm saying this will be a decade-long, at least, infrastructure sort of tailwind in Australia, and certainly for our business. We're getting strong revenues on all the major projects that you'd expect to see there: Melbourne Metro Rail, Bruce Highway upgrade, Western Distributor in Melbourne, Queensland Cross River Rail, Sydney Metro Rail. I'll talk about a couple of those in a bit more detail. Here's the way our business has tracked in this space over the last 3 years. So the actual market, and mind you, we're not a big spend at multi-billions of dollars. Our share of that is in the sort of the tens of millions. But our national infrastructure revenue has gone up by 56% over a time, when the actual spend nationally has gone up by 11%. So we're outperforming. You can see in Queensland, we went up by 50% revenue in Queensland between 21 and 22. Victoria, if I go back further to sort of 18 and 19, you'll see Victoria was as low as like 2. We've got significant market share growth in Victoria, holding that position. Had a cracking year in WA, and New South Wales we're underrepresented in New South Wales, but already after the first 2 months of this year and going into September, and knowing what our September result will already be now, I expect the New South Wales formwork revenue to just about double in 23, as we are definitely now gaining market share in New South Wales. Equipment hire revenue pipeline, you can see. So again, reiterating, 28.4% up year on year in terms of jobs secured. Our pipeline is at its highest point ever, at 83.9 million, 14% up on the same period last year. So we're in pretty good shape in terms of both winning work and what's in front of us. In terms of the civil infrastructure formwork quoting versus success rate now, we're batting it better than 50%. So basically 1 in 2 jobs that we quote on, we're winning the job. And I mentioned we're all on big marquee projects. Snowy Hydro is the one that's not a transport project, but is the biggest civil infrastructure project in the country. There won't be 2026 completion. It might be more like 2030 at the way that thing's going. It's a couple of $1 billion over budget. It's certainly a troubled project, but that's a bit of a so what for us. The thing is starting, it can't stop. It's probably the most important infrastructure project for the energy generation in the country. And 30 million is a very conservative number about how much revenue we will generate from that project. I mentioned others: Metro Tunnel, Bruce Highway, Westgate, Cross River, Sydney Metro, all of the major infrastructure projects in the country. We've got considerable revenues, and there's still some time to go on those. And there's a range of projects that will replace these as they come to their conclusion. Across our businesses, formwork, industrial and commercial scaffold, you can see the growth year on year, both in revenue and in contribution. So we're up 30% in revenue in formwork, up 36% in contribution, up 110% in revenue in industrial, and 53% in contribution. The reason why that was, a lot of that revenue growth was in labour rather than the hire of equipment. We're making around about an 18 to 19% margin on our labour on industrial projects. And that's all on do and charge. We don't do lump sum contracts like a lot of other companies. Ours are all basically, if we're paying somebody $60 an hour, we're charging the customer $72 an hour. And you can see that clearly the business is growing to the degree we have over this year. We've had to grow our structure to support a far bigger business. But we're still getting about 60% pass through from sales contribution margin through to EBITDA. And that certainly is continuing into the new financial year. And you can see that the EBITDA margin overall went from 23 to 24.5. And as I mentioned, after 2 months this year, it's actually sitting at 29 at the moment. The bridge of where the extra sales contribution came from: formwork hire, industrial scaffold hire, and industrial services labour. Those three areas, which is about $15 million, is where we're spending our capital. So our capital is generating the return, which is what you'd want to see. We already had very heavily utilised equipment, so what we're investing, we're getting very strong returns. I'll show that in a second in a bit more detail. The other one I want to point out here is timber sales. I'll just flip to the next page. So we sell timber and ply to form workers. We've done it basically for the 9 years I've been with Acrow, but it's in the last 12 months that the thing has really taken off for us. So our sales contribution margin in this area grew from 1.3 million in 21 to 4 million in 22, and the margin from 18 to 28%. This came off the back of us being able, well, it's a difficult market at the moment. I think if you follow construction in the country, it's a difficult market. But we've grown our market and our margins considerably because we found a really good channel of supply out of China. That does come with a working capital impost. It absolutely does. But we're prepared to buy the $5 million of working capital impost off to make a $4 million sales contribution margin on the sale that we make. And we're now doing close enough to $2 million a month of sales in this area from something that used to be sort of $500,000 or $600,000. Capital expenditure, we are in heavy growth phase at the moment. We will be probably for another couple of years yet. So last year we spent 21 million in capex. 14 million of that was in growth capex. Now we've got a really stringent hurdle rate of 40% return on investment in year one of any capex that we spend in growth, and we've done a lot of work on sort of backtracking what that has looked like over the last 2 years, and we're actually achieving an average of 50% on our capital investment for growth, and that's showing clearly in the revenue and the profit growth in the business over this period. We have increased our debt this year off the back of the growth, but we've also got an extremely supportive bank with Westpac, and our headroom available at the end of 22 has increased from 4.5 million to $13.2 million in headroom available through our funding facilities, and that's probably going to go up again shortly. They're incredibly supportive, understand that the business is in growth phase, will be for probably the next couple of years, and really supportive in terms of coming up with creative structures to get us the best results in our funding position. Obviously, successful businesses have good people working for them, and we're no different in that regard. We've done a lot in attracting good talent into the business. You can see some of the recent appointments. These are very high quality people coming into the business, and we're very strong on succession planning. Recently appointed a chief operating officer. The guy's 31 years old, been with the business 10 years, started as a trainee engineer, and now basically the two I see in the business. And you mentioned some of the other guys in there again are coming through the business. It's a safety first environment. It's all good things you'd want to be valued for. It's a customer driven, solutions focused. Hopefully we look after our employees, or believe we do very well. When we say set industry standards, we actually seek to exceed industry standards and then start to put everybody else on, I guess, a new level. One thing that's not in that on that list, but it is a fact of the way we run. We're incredibly financially driven, but not to the detriment of safety or our customers or our employees. But we have incredible disciplines around our profit focus and what we expect. I mean, I do forecasts with branches at the middle of the month and questioning down to hundreds of dollars as to why an expense may be more than it was in the previous month. Short-term, medium-term opportunities. We'll continue to grow industrial services. We definitely were going to pick up market share in New South Wales formwork. We're going to continue to ride the wave with our strong market share in Queensland formwork. We will get more organic growth across those smaller states as we move more product into those states. Western Australia is happening right now, that sort of further WA growth. We are now offering a more integrated engineering service, which means we're actually charging for engineering services that we previously provided for free. So that'll generate us probably $1 million of additional revenue this year by actually charging for services that we previously just threw into the package, and customers are happy to pay for them. And our screens business will continue to grow market share nationally. The big thing for us this year is this jump form product, which is jump forms. If you look at the photos there, this is actually Crown Towers in Sydney. The photo on the sort of the right of that page shows that if you look at the top of the building, that's the jump form coming out of the middle. It's the core of the building. It's where basically the lift shafts and the stairwells, etc., are formed by walls of concrete as the building goes up in floors, and the jump form supports that and goes with it. We've now got a system for the first time. We've won our first 2 projects, starting basically now. $4 million of revenue will make us about 2.5 to 3 million of EBITDA this year. Brand new channel of revenue. It's about a 70% return on investment in capital. We think we can grow this division to $20 million of revenue, probably making 10 or 12 at EBITDA within the next 24 months. So we have provided an outlook at the moment for 23, 165 to 175 in revenue. So usually 15% up in revenue. EBITDA, well, it won't be lower than 44, but we're saying 43 to 44, up 20%. Still further growth at NPAT, and EPS starting to head up towards 9s. As I said, we can do this at this point because I can see at least out now the January or February in terms of what the higher revenue is going to look like in the business, and that's the main driver. We had a lot of capital that we placed orders for last year that only arrived in the last quarter of 22. And then clearly the revenue and profit from the jump form work that we've won, as I mentioned, 4 million of revenue generating 2.5 to 3 in EBITDA. That's an absolute brand new channel. That's fresh EBITDA and fresh revenue compared to what we had last year. So, I'm again very confident in what we're going to be putting forward this year. The business has never been in better health than it is at the moment. So, Mark, I'll throw forward any questions.
Cheers, thanks, Steve. I just wanted to touch on, I know it's been as you touched on in the presentation, a few years since acquisitions were done and they're now completely bedded in, but would it be difficult for you to do future acquisitions given the size of Acrow now from an ACCC standpoint, or is there a few little bolt-on, really specialist engineering guys that would be complementary to the former or engineered services business that you could bring in?
Yeah, we wouldn't buy one of the other major formwork companies, not just for ACCC reasons, but just in terms of compatibility of equipment. Funnily enough, everyone's got their own sort of kit, and it's not all compatible. So we've got our gear, we've got our systems. We continue to focus on product development of our own systems, but we wouldn't be buying one of the other formworkers. Certainly in the industrial services space, we're really keen. And we only recently decided not to go ahead with a potential acquisition in that space because the current owners just wanted too much money, really, and they're just a bit unrealistic. So we've parked that one, and it may well come again. But there's definitely the sort of the bolt-on new product opportunities for us. So I think, but really, from the main M&A focus will be industrial services for us. That business we've grown just on the East Coast. And as I said, we're very keen to get into South Australia and Western Australia, and M&A would be the perfect sort of vehicle to do that. And so we did have a company that we're quite keen on, and they are a good company, profitable, well-run, owners who are getting to a point where they probably need to move on. There's no sort of family succession plans, but they're just a bit unrealistic at the moment with their return requirement.
Okay, and then I just want to touch on margins for a second. where do you think is kind of a steady state margin for Acrow if we look forward on a, you know, 1, 2, 3 year basis, you know, as the scale, you know, increases? Is it that 25 to 30% range? Is that kind of roughly steady state, do you think? And, you know, 30 in a good year, and, you know, 25 in a kind of average year?
Mark, it completely depends on the mix of the revenue. So just to put some guidance there, we've got 3 streams of revenue. We've got hire, we've got the provision of labour on industrial, and we've got the sale of equipment. So hire is 100% pass through in terms of the margin. It is 100% pass through. Our labour makes about 18 to 19%, and our sale of equipment averages somewhere in the 30s. So if we've got as we've had in these last couple of months, our revenue in July and August was very heavily slanted towards hire. And so in those months, we've got, as I said, we're pushing towards 30% margin. We have another month where we do some really big sales that we make maybe low 20s on the sale. And we've got a few of those coming up. We know that there's already a few coming up in the next 3 months. And that will reduce the margin in those months to the low 20s. So it totally depends on the mix of revenue. But you know, but that's why at the moment, to be honest, I've got more confidence about my EBITDA guidance than I have on my revenue, because I haven't factored in any really big sales into the revenue or the EBITDA. I know they're going to come at some point. So we've just picked up a couple of $1 million worth of quite large sales in the last 3 weeks that came out of sort of nowhere. But I'm basing our EBITDA forecast on what I know is there in higher revenue. That's absolutely transparent now. I can see at least 6 months out.
And then, yeah, if we just talk about the bigger projects, I know you're saying you don't believe that graph. It's gonna, and we all know Snowy Hydro is well over budget and going to run longer. And given where the world is now in the last 6 or 8 months on energy security, I definitely don't think it's going to be stopped. But in terms of these big projects that are going to come to an end in the next, let's call it, you know, 3 years or so, I'm thinking, you know, like Crossrail, Sydney Rail, those ones. What's some kind of marquee projects that either the, you know, state governments or federal government are talking about but haven't quite pushed the go button on, or tenders haven't been issued yet, that, you know, you're eyeing up, that you know is going to, okay, it might be 6 months from now or a year from now, but, you know, these are going to go live at some point? What are the ones, you know, people, once we see that going live, that we'll know Acrow are going to be actively tendering on?
Yeah, so there's quite a lot of projects that the button has been pushed on, but they won't start for the next 6 to 12 months. So in Victoria, for example, so the 2 major projects that we're getting in civil infrastructure getting significant revenue are is the Metro Rail and the Westgate Freeway and Tunnel. So the Westgate Freeway and Tunnel will come to conclusion in about 2 years, and it's going to be passed. It's going to be, you know, it will be surpassed in terms of size of project by the North East Link motorway in Melbourne. That's going to start in the next 6 months to 12 months. And then there is an underground rail system going into the eastern suburbs of Victoria, similar to New South Wales. So the Sydney Metro Rail, as it stands at the moment, which goes from sort of Marrickville to Chatswood, is basically almost probably 12 months from conclusion. But now contracts are being let for the Inner West Rail and the Outer West Rail. So these things will just kick in. One of the big projects at the moment, when you're looking at Acrow in 12 months' time, that you'll see a lot of revenue, and we're talking a lot about Sydney Gateway. So Sydney Gateway is the motorway development that takes us to the international and domestic airports. I don't know if anybody's been to the Sydney domestic airport recently, but you'll see a hell of a lot of work going on in terms of overpasses and bridges going into the domestic airport. All the formwork equipment on those projects is ours. We just won a $1.2 million package on that project about 3 weeks ago. So there is certainly, and then they're going to Queensland. The big one in Queensland will be the inland rail. So the whole inland rail that basically runs through almost the Great Dividing Range. So that project, again, tenders are being let, packages are coming out. So I'm not, again, I can almost see like for like replacements for all of the major projects that are there at the moment that are coming to conclusion in the next 2 years, certainly in those 3 states. With new projects that will be kicking in.
Okay, great. I think we've got time. Yeah, let's try and get in one more question if I can. On the formwork timber, is there other little revenue lines within Acrow that you think can potentially like grow out like the formwork timber? As you say, it went from you know, the 500,000-600,000, you know, up to the 4 million mark, I think it was on the slide. Is there a few other little kind of hidden gems within Acrow that you think we, you know, if we put a bit of focus on this and put a bit of capital towards it, you know, it can be a nice kicker to the bottom line and the overall result?
We think we can do more in timber still. So there's certainly, we could probably double the timber business if we can get the right arrangement, sort of working capital arrangement, because we've got to pay for that stuff basically up front, and then there's about a 4 to 5 month working capital lag, right? So that's one thing that we know, and we're talking to our bank at the moment, and they're quite very supportive. We could probably double the revenue in that and profit in that business if we're prepared to sort of suck up the working capital impost that would have on us. The other sleeper, and it's gonna, you'll see it if you watch our results this year compared to last year, we're getting margin growth on our small commercial scaffolding business for the first time in about 8 years. Our rates are going up. Now that business is a supply and demand market. We're not going to put any capital into it, but in terms of just growth, there is not enough gear in that market at the moment, and rates are going up. So you'll definitely see improvement in that part of the business this year for us. But look, I'd say, look, the timber, and then in terms of our hire equipment, Mark, it's that jump form business. You know, once we get these first 2 contracts out of the way, and make sure we've got the system 100% right, and we're providing the service the customer wants, we're going to be talking in November, December at a board level about significant upgraded investment into that, and that we won't have trouble finding jobs for that business. It's really going to be up to us in terms of execution. The market is there. We're being asked to join markets. We're being asked to quote on jobs all the time. As I said, that's going to be, I've got no doubt within a couple of years, you'll see $20 million of revenue coming out of that business and 10 or 12 of EBITDA from nothing last year. And this year, probably, you know, 4 and 2.5 to 3.
Okay. We will leave it there, Steve. Thanks very much again for joining us. And yeah, this is, if you include the in-person presentation, the 4th time you've come back to give us an update at Coffee Microcaps. So thanks very much for your support and coming back in on a regular basis to keep us updated.
Thanks, Mark. Good on you, mate. I'll do the stop share thing now. And
yeah,
there you go.
Great. And I can see Scott is waiting for us there patiently.